Time and time again, we get people wanting to compare dividends from one company to the other. And we've written about this, we've recorded podcasts about it, but I think it becomes really clear when we can look at it in a balanced apples-to-apples comparison here. And so, are dividends really everything that they're cracked up to be? That's a good question. Let's examine the facts. Dividends are, first of all, approved by the board of the insurance company once profits have been declared. Dividends are a compilation of profits minus mortality cost minus investment costs that the company experiences. Dividend projections are assumed. They are not contractually guaranteed, and dividends rarely meet the projected illustrated assumptions. Time and time again, we can see they're either off higher or they're off lower, but they rarely ever are exactly what they were projected to be. Dividend rates are reported differently by each company. We talked about that in our podcast 89 with an insurance company about how even sometimes inside an insurance company, dividends are thought to be different things. Dividend comparisons between companies then becomes very difficult if a company itself has a disagreement inside itself internally about what the dividend really should be. And why is that discrepancy there? It's because some people want to say the dividend is before the mortality costs have been figured out. Or another company might want to post their dividends based on what the profits were before the investment costs were taken out. And so we have to know what we're comparing before we can compare it honestly. Dividends when purchasing paid-up insurance. That's an option you can have when you buy a participating whole life insurance policy, is have the dividend purchase paid-up insurance, is a good measure of what's really happening with the dividend. It gives us the ability to compare dividends more accurately between company and company, and that's what we're going to look at here today. Let's take a look at Mendy. Mendy was a prospect who brought her participating whole life insurance policy to us. It was sold to her by another agent, and she wanted us to do a complimentary analysis on it. After we analyzed her policy, Mendy became aware that her projected dividends will never add up to what she was led to believe they would when she purchased the policy. Let's take a look at what Mendy now understands about her dividends and how critically important it is for you to understand dividends fully before you purchase a whole life policy. Here's the premiums Mendy paid on her policy on the top in blue, and what Mendy could have paid in a possible policy that we re-illustrated for her. What happens here is she ends up paying 35% more in premiums on her policy than she did in her possible policy. Her guaranteed cash values are 31% more, but that doesn't justify the reason that she paid 35% more for the policy. She's still losing some ground there. Her guaranteed face values are less. So she gave up guaranteed values for a higher projected dividend in this case. Total dividends projected were 64.7% more than her possible policy that we illustrated for her. And her total face value and should have reflected that higher premium paid and higher dividend rate projection, but in factuality, they don't. They're only a 9.7% greater, not the 60% greater of dividends that we were looking for in the projected values. So her total cash values then are slightly higher comparatively, but they're nowhere near the 60% and nowhere more than what they could have been had they paid a lower premium for the same type of coverage. So let's take a look here. If we look at Mendy's policy and look at her total face value, 39.5% of that face value came from her total premium payments. So if you look at her total premium payments and overlay them on top of her total face values, 39% of what she's going to get in face value is what she paid into the policy. Whereas on a policy that was possible for her with the same premium, she could have only paid 28% of that total face value. Quite a difference when we look at it, especially when you consider that the possible face value would have only been 9% less than the face value she currently is going to get in her policy. So where did Mendy's dividends go to? Well, Mendy's policy experienced a 9% total face value increase. Mendy's policy projected a 64% greater dividend, though. But Mendy's policy only experienced a 40.9% increase in total cash value over her possible policy, and Mendy's paid 35.2% more for her policy than she would have paid for the possible policy. Furthermore, 39.5% of Mendy's total cash value at year 20 is made up of what she paid in premium, while only 28.4% of her possible policy would have been made up of what she paid. This example proves several things. Number one, that higher premiums don't necessarily provide higher dividends. That higher dividends don't always correlate with total cash value. We saw that in Mendy's case. That higher dividend projections don't guarantee higher face values. Again, we saw that in this case. That higher dividend projections can actually lower guaranteed cash values. Now, they don't actually lower it, but that's the trade-off that takes place. Oftentimes, when a high dividend projection is on an illustration of a policy, there are lower guaranteed cash values. Guaranteed. That dividends should never be counted on until they're paid and applied. And that thinking in percent helps us determine the value of the dividend projections. By looking at the percentages between dividends and face value that the dividends were supposed to purchase, that helps us correlate and be able to compare an apples to apples relationship between policies rather than just comparing dividends to dividends. So let's look at another case. Greg was a client that came to us with a policy from a different company, and we were able to create a policy for him that was much better based on something that happened to Ben, who was actually Greg's same age and was in the same insurable class, and were actually paying the same premium that Greg was paying. And so here we go. They were the same age, they were the same health class, and they pay the same amount for a participating whole life insurance policy years 1 through 4. After year 4, Greg's policy's premiums go higher, and he has a higher projected dividend rate, but lower guarantees, just like we saw in Mendy's case. After year 4, Ben's policy has a lower premium and a lower projected dividend, but much higher guarantees. So let's take a look and see what happens over a 20-year period of time. Greg ends up paying more premium for his policy, obviously because he's paying more in premiums after year 4. Let's look at the guaranteed cash values. Just like with Mendy, there's less guaranteed cash values in what he's paying versus what Ben's paying, even though Ben is paying a lower premium over a 20-year period of time. The projected dividends weren't 64% higher. They were only 50% higher in Greg's case. Like with Mendy, Mendy was over almost 65% higher. But Ben's is much more reasonable projected dividend. Total face value, very close to being the same. Greg's policy only has 5.9% more face value, but remember, he had a 50% more projected dividend rate, which goes to buy more total face value. Total cash value, he ends up with only 18.4% more total cash value, which is a reflection of how much paid-up insurance you have, which dividends are supposed to purchase. So you would think that there would be a much higher total cash value rate in Greg's policy based on that 50% dividend rate. But in actuality, when we compare apples to apples, it doesn't correlate. So where did Greg's dividends go to? Greg paid more premiums, Greg had a 50% more greater dividend projected value than Ben, but Greg's policy only shows a 5.9% greater face value than Ben's. That doesn't correlate. That doesn't make sense. If the higher dividend rate is there, we should see a greater total cash value. But Greg's also has less guaranteed cash values. So Greg gave up something for a higher projected dividend that he didn't get. On top of that, Greg's policy only shows an 18% greater total cash value than Ben's policy. So again, at the end of the day, we have to ask, where did Greg's dividends go to? They didn't turn out to be what he thought they were going to be. They didn't give him the higher cash value, and they didn't give him a significantly higher face value either. Are dividends really everything they're cracked up to be? That's the question we started out with to answer. And emphatically, the answer is yes. But not what some people want to make them out to be based on projected values. So what can we do about that? Well, here are 7 things that you can do to protect yourself and your money from being put into a policy that isn't going to perform, that is going to be based on high projected dividends. Number 1, always request a complete illustration that shows guaranteed values. It is surprising how many illustrations that I receive across my desk from policies that have been written by other agents with prospects wanting me to review them that come in with only non-guaranteed values. Non-guaranteed values are just what they say. They're non-guaranteed. We've got to look at the contract. We've got to see what is there, what is guaranteed. And then we've got to make sure that the face value in that guarantee is worth the price you paid for it. If you're paying more for it than you could someplace else, then most likely you're giving up guarantees for a projected dividend. And we know from these cases that we just looked at today what projected dividends really are. Always compare guarantees to guaranteed values. Don't try to compare the difference between non-guarantees and non-guaranteed values from policy to policy because of the fluctuation in how dividends are reported and how they actually correlate into purchasing total face value and producing total cash values. Always purchase the lowest face value with the highest guaranteed cash value policy. That means that you are experiencing the greatest possibility of getting a dividend that is going to work for you. If we start out with the highest cash value possible and the lowest face amount, that means we're paying the least amount for the insurance that we're getting, but we're getting the guaranteed results at a higher level. And like my grandmother always used to say, a bird in hand is worth 2 in the bush. So don't chase high dividends. Don't chase high total cash values. Look at the guarantees. That is where it's at. Always note when guaranteed cash values exceed premiums paid. This is crucial. This is how Ben was able to save so much more money and have a better policy than Greg's. Greg's policy continued to pay premiums indefinitely at a higher rate, whereas Greg paid those higher premiums Ben only paid those policies for 4 years and was able to reduce the cost and allow the dividends actually to produce the total face value that he was getting rather than that total face value coming out of his pocket expense. Always check to see if dividends increase total cash values significantly. That's what we did in these analyses, and that's what allows us to compare one policy with one company to a policy from a different company, regardless of how they report their dividends. Always read and understand your contract before you accept it. How critical is that? This requires a comprehensive and detailed analysis, and we at Life Benefits would be honored to complete that analysis for you, but we need a commitment from you. It takes time to run these, and we want to make sure that if we can save you money, that you'll commit to working with us because we have your back. We want to make sure that the product that you're getting is going to work for you with the Perpetual Wealth Code the way that you designed it. And you're not going to end up on the short end of the stick having expected high dividends that didn't pan out to higher face values and higher cash values that you can control, maintain liquidity over, and put through the perpetual wealth code to create more wealth for you in your life and to keep more of the money you're making.